We covered a lot of information in this chapter, and you might now be wondering, what does it all mean? In his 2024 book, Nexus, author Yuval Noah Harari writes, "History isn't the study of the past. It is the study of change. History teaches us what remains the same, what changes, and how things change." Although past results don't guarantee future results, the information in this chapter serves as a guide for what has happened in the past. Looking forward, it can be used as a baseline for what we might expect to happen in the future. If you're a hockey fan, the easiest way to think about it might be statistics. We can use previous year's statistics, like goals scored, to gauge what we can expect to happen in the future. We know that in the NHL, a player scoring 50 goals in one season is a huge accomplishment. We know that because we can look back at historical data to understand how rare it is, and that the top goal scorer in a given season is usually around that mark. For example, in the 2023-2024 season, only 4 out of the 924 skaters in the NHL scored 50 goals or more. That ratio is pretty normal throughout the modern era. In a given season, we can expect that only a handful of players, out of nearly 1,000, get close to that mark. If we focus back to this chapter, we now know that based on a portfolio's asset allocation, we can expect it to behave differently than other portfolios with other asset allocations, both in terms of expected returns and expected volatility. And this difference can change depending on the phase of the cycle the market is going through. Knowing what we can expect for returns allows us to more accurately plan for the future. Long-term success is a function of 3 things: returns, contributions, and time. If our expected returns are way off, it's going to impact our ability to reach our goals on time. The sooner we can have realistic expectations, the sooner we can get everything working together accurately. The truth is that markets move a lot, and as investors, we can expect that our portfolio will move along with it. But that movement is normal. Markets drop at least 10% within a calendar year, more often than not. So when we hear about the news and the media freaking out about the market dropping 1% in a day, we know that's nothing to worry about. The market would have to drop more than 20% in a single day to reach uncharted territory. Looking at previous market bubbles, they all revolve around the idea of trying to force long-term results over a short period of time. Although a few get lucky from bubbles, the majority of investors get burned. As investors, market-wide bubbles are unavoidable, while concentrated bubbles are something we want to avoid. We want to behave rationally when everyone around us is behaving irrationally. That is easier said than done. So something we want to focus on is what's within our control, instead of focusing on what's outside of our control. We can't control the markets or the returns that they produce, but we can control things that influence our returns, like how we invest, the amount of money we have invested, and how we behave. This chapter has been all about looking back at what has happened so we can have a better idea of what might happen moving forward. When we have a better idea of what we expect to happen, we won't be surprised when those normal things do happen. This can allow us to make better decisions and ultimately be more successful investors. The average returns we looked at earlier take into account the volatility, negative years, and market crashes that have happened. If we look at a chart showing the historical ups and downs over the last 120 plus years, the advantages are obvious. The positive years outweigh the negative years, both in duration and in amplitude, meaning that we see positive years more often, and those positive years have returns that far exceed the returns from negative years. This results in exceptional long-term returns. When we zoom out to see the S&P 500 over the past nearly 100 years, we see that previous crashes, which at the time impacted the entire world, are barely noticeable. The Great Depression barely registers, same with the crashes in the 60s, 70s, and 80s. And with enough time and compounding, even the dot-com bubble, the financial crisis, and the COVID crash will be barely noticeable as well. When we look at the historical information from this chapter and consider the impact that time has on our investments, it can make investing a lot less scary. If we think back to our road trip scenario, Panicking at the first sign of a market downturn and altogether giving up on investing would be like ending your road trip at the first sign of inconvenience, like stopping at a red light, having slower progress through traffic, or approaching a construction zone. Of course, it's ridiculous to cancel a road trip over something as minor and insignificant as any of those examples. And we know that it's ridiculous because we understand that those are all normal aspects of driving. We expect those things to happen. So when they do happen, we're not surprised in the slightest. When we understand the normal aspects of being an investor, especially when it comes to risk, it can allow us to focus on what really matters, which helps us make better decisions, which ultimately leads to the success that we're looking for as investors. And it all starts with having realistic expectations for how investing actually works.